Hey investors, thank you so much for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today I want to talk about Skillz. So I've kind of called this article here why I'm taking lessons from Epictetus because it's really something that he said and I should have listened and it would have caused me to miss out on a lot of pain. So here's a quote that he said. He said that what's the first business of one who practices philosophy? To get rid of self-conceit, for it's impossible for anyone to begin to learn that which he thinks he already knows. So, the evidence was clear, but I believed that I knew the right answer and I had nothing left to learn here, and yet I was totally wrong. And even though the share price is down even more since I kind of stopped following this, stopped being invested here, even now at this price, I don't think that it's worthwhile investing. So here's some context, right? So on the at the end of the 4th of November, to gather the Q3 results, I said to my marketplace, okay, enough's enough. We should call it a day here. This investment isn't working out. Since that date, the 4th of November, the stock has just gone down, way 50% in a few weeks. And I get the background, right? So many stocks in tech are down. That's fine. I mean, that's just how it is. That's the thing with a bear market. There are some things that should be sold off justifiably. That's why it's a bear market. There are some things which I believe should not have sold off and have sold off. And if you're doing a bit of work and you can build some conviction there, I think that's why you really kind of pay dividends. Because everyone, when the market's going up, everyone's a genius and everyone's making money. It doesn't really matter. It's really your ability to go through the cycle and sift through and get the confidence that you have to kind of navigate this period that really pays dividends over time. So, um, you know, the reason that I had said at the time to call it a day wasn't so much that the stock was down when I sold it. It was down when I sold it, but it's just I had no faith in the potential of the business going forward. In the market, you always have to be thinking ahead. What's the potential from this price point looking forward? And yeah, so that's why I was kind of wrong. And as you can see, it was actually a good decision in hindsight. But I'm not taking a virtual up, absolutely not. So here's the thing. So including the acquisition of Archie, I hope I pronounced that right, Skillz is expected to put out approximately 68 to 70% year-over-year growth. Fantastic, right? The problem is, as we come around to lapping this year, 2021, and look to 2022, it's going to be kind of difficult for the business to be growing, right? So if you have a business that's not really going to be growing as strongly, and you have an unprofitable business, that's not a good combination, okay? That's the one thing that I want to kind of highlight. So the question that always overhangs here is whether Skillz can grow without offering the user bonus. And the verdict is still out there. It's far from conclusive one way or another. What is conclusive is this, right? So this is what I wrote in November. So Skillz' balance sheet carries at the end of Q2. It carries approximately, at the end of Q1, it carries approximately 613 million of cash on the balance sheet. At the end of Q2, after the exercise of the warrants, cash goes up to 693 million. Q3, cash comes down by a substantial drop of more than 150 million to 540 million on the balance sheet, okay? And I wrote at the time, the Skillz doesn't have that much cash on the balance sheet, so that means it'll have to raise some capital. Skillz will struggle to raise debt on anything but highly restrictive terms. But this only leaves one option for Skillz, and that is to dilute shareholders further. Now, part of this wasn't right, so I didn't get it right that they would dilute shareholders. I felt that they would, and they didn't. What they did do was raise debt at 10.25%. So that's like that's a junk bond essentially. So creditors are looking at Skillz and thinking, okay, I need more than 10% interest on something that is on notes that expire in 2026 because I don't know if this business is going to be around. So creditors believe that this is kind of a bankruptcy potential. So that's why its prices, the interest rate on the bond is really, really high. Now, this is the thing. So in Q3 21, you have a business that holds no debt. It is unprofitable, but it holds no debt. Going now into Q4, you have a business that has a significant amount of debt, paying more than 10% interest on the debt, and isn't profitable. And there's question marks about its revenue growth rates. So with all that, it's kind of like difficult to really get compelled and beat your fist on the table saying that this is a great investment. Now, the reason why I was really attracted to this business in the first place was because it really has a very high gross margin. So Q3 21 gross margins were 93% of revenue. Wow, really, really strong gross margin, right? But as we look beyond the gross margin, we see a business that is meaningfully unprofitable. In fact, if you look here at the figures, the EBITDA figure, adjusted EBITDA, has actually increased more negative by 70% year over year. So going into Q4, if Skillz is expected to grow top line at 70% year over year, but its bottom line profitability is also going worse 70% year over year, that's not a high quality business. They're getting no leverage from the business. Now, hindsight is always really easy, right? And I wish that I didn't get involved with it and I kept buying as it kept on falling. But I know from my own experience that the market doesn't care the price that I paid. All the market cares is what the business is worth. In the case of Skillz, it wasn't worth anywhere near what I believed it was worth. And when it comes to it, there are so many things that I should have spotted sooner. I should have spent a bit of time trying to see that the business is becoming more unprofitable as it grows. But then again, from the other side of the equation, the verdict is still out because the thesis of Skillz' thesis is that they're growing their paying user base. So if you grow your paying user base, that's the idea. So it should be kind of like Netflix. You don't look at Netflix and say, okay, Netflix is valued so much, not because it's making a lot of free cash flow. It barely makes any free cash flow. Netflix is priced so expensively because as they grow their user base, their paying user base, they're able to grow their revenues. There are some kind of question marks over the accounting of Netflix, about the amortization of their library, but for all intents and purposes, it's not a business that's meaningfully profitable, and it's a business that is really, really expensive. Like more than like 250 to 300 million market cap. In the case of Skillz, it's kind of still the question mark. As long as they're growing their user base, there is the validity that the business has some traction. So it's kind of like, and also a thing that I always look for is that has a lot of the founder still runs the business. They have a lot of stock in the company. So all these things kind of were tallied up, but just didn't work out. Like I understand that the founder is really, really devoted and stuff like that, but sometimes things just don't work out. But if you want to find out what kind of stock that investments that I am looking at right now, because as I talked already before, that there's so many great opportunities right now. And yeah, if you want to find out those, don't forget to come and check out our marketplace called Deep Value Returns. And you can see what other people said. Check out the reviews from my marketplace. Yeah, and hope to see you soon. Thanks for listening. See you soon. Bye.